Let's review the job of an investor. There are only a few managers or people who make money from the markets. Most people make money from people trying to access the markets. If you are not one of the few making money from the markets, then your job is to access the markets you want to invest in for the lowest possible price. Let's review the recent 5-year period from 2012 to 2016. This is data from Morningstar.com covering over 1,000 U.S. large-cap blend mutual funds. 0.5% of the population outperformed the S&P 500 by over 2% annually. These were the superstars. 3.6% of the population outperformed by 1 to 2% annually, and another 14.7% of the population outperformed by under 1% annually. Now let's look at the underperformers. 31.8% of the population underperformed the S&P 500 by less than 1% annually. 21.5% of the population underperformed by 1 to 2% annually, and a whopping 27.8% of the population underperformed by over 2% annually. This is massive value destruction. 81.2% of the population underperformed. But let's look at that top 1/2 of 1%. There are 5 of them out of over 1,000 funds. Here's how they stacked up. None of them had lower risk and higher return than the S&P 500. As a group, they had 16% higher average annual returns and 21% more risk. Let's look at the number one performer. They delivered 20% higher average annual returns for just 5% more risk. The question is, would you have invested in this fund before the great 5-year run? For starters, that fund only has $5 million in assets, so you were unlikely to even know of its existence. But even if you knew of the fund, how did it look heading into this great 5-year period? Well, the 5 years beforehand, from 2007 to 2011, that fund was a massive underperformer, underperforming the S&P 500 by over 2% per year with more risk. It's unlikely that you would have decided to jump into this small underperforming fund just in time for the great 5-year run. Stop guessing with your money. There are very few people or funds who make money from the markets. Those rare few are very, very hard to find ahead of time. Vast amounts of money are wasted in a futile attempt to find them. We believe it is preferable to access the markets for the lowest possible cost. Modern portfolio theory highlights the value of attempting to construct the tangency portfolio. We offer the Supernova Asset Strategies Tangency Portfolio, comprised 100% of ETFs. Underlying ETF fees are around 0.3%. Here are our disclaimers and our asset class references. We encourage you to reach out to us to discuss this in more detail.